Franklin D. Roosevelt, president of the Rockefeller-controlled Wabash Railway, known as Uncle Fred, I think, in the New Deal period. William P.G. Harding was president of the First National Bank of Birmingham, Alabama. And son-in-law of Joseph Woodward was head of the Woodward Iron Company, which had several prominent Morgan and Rockefeller people on the board of directors. And finally, an economist, Professor Adolph C. Miller of the University of Chicago, and the land economic technician prestige. However, he wasn't just an ordinary economist. He had married into the wealthy Morgan-connected Sprague family of Chicago. His father-in-law, Otto Sprague, had been a prominent businessman and served as the director of the Morgan-dominated Pullman Company, and his wife's uncle, Albert Sprague, was director of the Chicago Telephone Company, subsidiary of the American Tel, which essentially was a Morgan-controlled monopoly. So then we have, in other words, the Federal Reserve Board beginning its existence with 3 Morgan men, 1 Rockefeller type, and a Kuhn Loeb, ally with the Rockefellers, a prominent Alabama banker, and an economist with vague Morgan family connections. That's the disinterested public interest at work. Okay, the guy who controlled the Federal Reserve System with an iron hand from the beginning until he died in 1928 was governor of the Federal Reserve Bank of New York, Benjamin Strong. He ran the system, much to the dislike of the Federal Reserve Board in Washington. And after he died, the law was changed to ensure the Federal Reserve Board was running things and not the governor of the Federal Reserve Bank of New York. Who was Benjamin Strong? His policies were inflationary throughout and all that. So that's one to talk about his policy. But who was he? Where did he come from? Again, he didn't drop out of the sky by divine edict. He had spent before this virtually his entire business and personal life in the circle of top aides of J.P. Morgan. He was secretary of several trust companies in New York City, and he lived in a suburb of New York, Englewood, New Jersey, which in those days was a very wealthy suburb. It's come down a bit since then. And Englewood, he became close friends of 3 top Morgan partners, which is the next best thing. If you're not a friend of Morgan, you'd be a friend of 3 top Morgan partners. Henry P. Davison, we mentioned already, Thomas W. Lamont, and Dwight Morrow. Davison became Strong's mentor and offered him the post of secretary of the new Morgan-created Bankers Trust Company. What was happening was the trust companies were popping up in that period. The banks wanted to get a piece of the action, and so Morgan created Bankers Trust for that purpose. Soon after that, Strong again cemented his alliances by marrying the daughter of the wealthy Edmund Converse, president of Bankers Trust, and he soon succeeded Thomas Lamont as vice president. So you marry the daughter of the president, you're a pal of 3 Morgan partners. Okay. And not long afterward, Converse was getting old, and he becomes the virtual president, vice president, virtual president. Okay, Strong had favored central banking until at least since 1907, and in August 1911, he participated with Nelson Aldrich in a lengthy meeting on the Aldrich Plan with Davison, Vanderlip, and a few other big shots on Aldrich's yacht. Okay. When the Federal Reserve System was established, Warburg was also a close friend of Strong, offered the post of governor of the New York Fed to Strong. And first he said no, he refused. He doesn't like the Fed because it's not enough of a central bank. He wants to run from New York, as he said, by board of directors on the ground in Wall Street. After a week in the country, Davison and Warburg persuaded Strong, don't worry about it, fella. This will be a central bank, and you'll be running it. And at that point, he accepted the job and became governor of the New York Fed. We proceeded to assume absolute power. Okay, that's essentially the story of the founding of the Fed. As he put it, as Strong put it he put it, for example, that when he was worried that the state banks refused to join the system, state banks had the option of either joining the Fed or not, and he was worried about it, and he said in a letter in October 1916, frankly, our bankers are more or less an unorganized mob. Until they are educated by experience of the advantages of cooperation through the reserve system, I believe it is unsafe to rely upon reserves contributed by their voluntary action. In other words, force them into the system. And that way, every cartelist has always complained about individual businessmen who kick over the traces and don't accept the collective discipline of the cartel. Okay, Senator Carter Glass said when he drew up the Glass bill, final Federal Reserve bill, and he said afterward, he looked back on his handiwork and he said that he thought it was great stuff about 2 years later, and he said, the proponents of the Federal Reserve Act had no idea of impairing the rightful prestige of New York as the financial metropolis of this hemisphere. They rather expected to confirm its distinction and even hoped to assist powerfully in wresting this scepter from London and eventually making New York the financial center of the world. Indeed, momentarily this has come to pass. And we may point out, Carter Glass goes on, to the amazing contrast between New York under the old system in 1907, shaken to its very foundations because of 2 bank failures, and New York at the present time under the new system, serenely secure in its domestic banking operations and confidently financing the great enterprises of European nations at war. Okay, that concludes my talk. Thank you.
Murray, thank you very much. Again, a most informative and detailed and interesting discussion. I think we can piece some things together from what we've seen thus far. Professor Peden was up here telling us about government and inflation and how the government inflates. And one of the major messages I think we found in what Murray said is that when government becomes partner with the banking community, then that inflation becomes even more inevitable. And the incentive system becomes one where it's in everybody's incentive who controls money and credit for even more inflation. Well, we have a few minutes for some questions. We're going to adjourn for lunch about 12:15, but please let's ask some questions. Now, we'll have time later on to can talk to Professor Rothbard at lunch or after our seminars today.
I've been saving this question up for a long time, and I haven't had a chance to ask it to you, and it's related to money, but not necessarily the history of the Federal Reserve. Right now, there's a lot of banks, or have been over the last few years, failing, and then the FDIC comes in and bails them out. And I haven't figured out what the effect of that is on the economy when money is taken out of the system because of the failure of the banks, and then the FDIC comes back and puts some new money back in with T-bills or whatever it does to prop it up. I know it has something to do with the business cycle, but I'm confused about exactly, I mean, this is monetary inflation, but you're not necessarily seeing a whole bunch of price inflation, and one of the things I think I'm confused about is which causes the business cycle, what causes distortions in the economy. I guess there's a lot of questions and all wrapped up into that, but what is the effect of banks failing today with the existing system where the FDIC comes back in and props it up? What is it going to do to the economy? What can we expect from here on out? Deflation of prices, inflation of prices, or what kind of distortions?
Well, I think what's happened since, a sea change happened in 1933, namely the Fed had always been hampered in its inflationary potential and saving at the banks by the fact they had a gold standard to worry about. The Fed couldn't inflate too much because they had to pay in gold also. And so there were literally thousands of bank failures during the early 30s. With the federal, with the going off the gold standard and with the FDIC, the Fed now had unlimited power to expand and inflate. And when the FDIC bailed out, for example, a Continental Illinois National Bank, they only had to bail out the people with deposits of $100,000 and under. They decided to bail out everybody. So they've already expanded now the FDIC as universal deposit insurance. And the use of insurance, of course, is a euphemism. It means the government prints money and bails out the banks. The key thing is the Federal Reserve has the unlimited power to print money. That's the key. To manufacture money. Instead of money being minted in gold or whatever, dug out of mines and painfully minted, making it therefore very scarce, which preserves the soundness of the money unit. Instead of that, the government, the Federal Reserve, has the unlimited power to print whatever it wants. And so what it does is it prints 8 billion, 30 billion, whatever, and bails out banks, buys assets or whatever. The technical, they do it to the tune of a lot of crises, a lot of jetting back and forth across the world to save the third world nations. But basically what it means is it's very simple. Basically, it is the Fed prints dollars and hands it out. Okay. So this is monetary inflation. It's expanding the supply of dollars. That's the distortion that creates the business cycle. And in order to try to eliminate recessions, which are the cause which is the result of inflation, they try to inflate more. So it's a sort of a spiral operation. And I've been in a constant argument with my hard money colleagues now for at least 10 years about whether deflation or inflation is on the horizon. And one of they sort of, in a sense, they have proclaimed victory recently because they redefined deflation. Deflation now means any inflation of less than 10% a year. Okay, talking about changing linguistics. I take the old-fashioned view.